3 seconds is all it takes to plunge us into the biggest financial crime in Indiana history. A staggering $12 million stolen from right under the noses of hard-working Hoosiers. This isn't some shadowy tale of clandestine operations. It's the story of a man named David Ricks and his elaborate Ponzi scheme that shook the foundations of Indiana's financial landscape. Imagine this, for over 2 decades, from 1982 to 2003, Ricks managed to convince thousands of investors to trust him with their life savings. The promise? An unbelievable 12% return on investment, almost 3 times the national average. With slick presentations and an affable demeanor, he drew people in, painting a picture of financial security and prosperity. But behind closed doors, Ricks was living a lie. Instead of investing the money as promised, he used it to fund his lavish lifestyle, complete with luxury cars, expensive homes, and even private jets. All the while, new investors' funds were used to pay off old ones, creating the illusion of profitability. When the SEC finally stepped in and froze Ricks's assets in 2003, the truth came out. What seemed like a golden ticket to financial freedom was actually a house of cards built on deception and greed. It wasn't just millions lost. It was retirements, dreams, and futures stolen from unsuspecting victims. As we delve deeper into this tangled web of deceit, we'll meet those affected, uncover the red flags missed, and explore how such a massive crime could go undetected for so long. Welcome to The Money Trail. Join us as we trace the footsteps of one of Indiana's most notorious financial criminals. The story of Indiana's biggest financial crime involved several key players, each with their own roles in this elaborate scheme. At the heart of it all was Timothy Durham, a wealthy businessman from Indianapolis. Durham was the majority shareholder of Fair Finance, a company that sold investment loans to average Hoosiers looking for safe places to put their money. However, things weren't as they seemed at Fair Finance. A significant portion of the investments were used not for purchasing receivables, but instead to fund Durham's lavish lifestyle and other businesses he owned. This included millions spent on luxury cars, private jets, and even a mansion in California. James Fletcher, an old friend of Durham's, served as the president of Fair Finance. He played a crucial role in luring investors by assuring them their money was safe. Meanwhile, Rick Snow, another longtime associate, acted as the company's CFO. Despite knowing about the misuse of funds, both Fletcher and Snow turned a blind eye, allowing the fraud to continue unchecked. On the sidelines, but equally complicit, were various enablers, accountants, attorneys, and bankers who chose to ignore warning signs or actively helped conceal the illegal activities. Some of these professionals worked for large firms based in New York City and Chicago, highlighting how this crime wasn't confined to Indiana alone. The victims, on the other hand, were hard-working individuals from all walks of life. They had trusted Fair Finance with their life savings only to see it vanish before their eyes. Many were elderly, relying on these investments for their retirement years. Their dreams and futures hung in the balance, shattered by Durham's greed. As we journey along the money trail, we'll meet some of these victims, hear their stories, and understand the devastating impact this crime had on them. We'll also explore how such a large-scale fraud could go undetected for so long, despite regulatory oversight and annual audits. Stay tuned as we unravel the complex web of deceit woven by Durham, Fletcher, Snow, and others in what turned out to be Indiana's biggest financial crime. As we delve into the labyrinth of Indiana's biggest financial crime, let's first illuminate the initial fraud scheme, a textbook Ponzi scheme orchestrated by the quartet of financial fraudsters Tim Durham, Jim Fletcher, Dan Stone, and John Muscarello. The epicenter of this scandal was Fair Finance Company, a Columbus-based firm that Durham controlled. Between 2005 and 2009, Durham, Fletcher, and others defrauded over 5,000 investors, amassing an estimated $200 million. The scheme was intricate yet simple. They lured unsuspecting investors with promises of high interest rates, up to 12%, on short-term loans secured by auto titles. However, instead of investing these funds in vehicle title loans as promised, they diverted them to other businesses controlled by Durham and Fletcher, a blatant violation of federal securities laws. Furthermore, they fabricated financial statements to deceive auditors and regulators. For instance, Fair Finance's annual report for 2007 showed $36 million in assets, but nearly half of that amount was non-existent, a phantom figure designed to create an illusion of prosperity. Meanwhile, Durham used millions of dollars to fund his luxurious lifestyle. He bought multi-million-dollar mansions, private jets, and even sponsored Indy Racing League teams. Simultaneously, Fletcher indulged in extravagant travels and gambling sprees in Las Vegas. The scale of this fraud was monumental, given that Fair Finance was a small operation compared to other financial institutions. Yet it managed to ensnare thousands of investors, many of them ordinary Hoosiers who trusted Durham and Fletcher with their hard-earned savings. So how did they manage to pull off such a massive fraud without raising red flags? That's what we'll investigate next as we delve deeper into the systemic failures that allowed this crime to flourish unchecked for years. Regulators and law enforcement agencies are supposed to be the first line of defense against financial crimes. But in the case of the biggest financial crime in Indiana history, they missed critical red flags that could have potentially stopped Durham and Fletcher's fraudulent scheme earlier. The Securities and Exchange Commission, the agency responsible for enforcing securities laws, was one such institution that failed to act promptly. In 2009, the SEC received an anonymous tip about suspicious activities at the pyramid companies, but it wasn't until 2013 that they launched a formal investigation. By then, the damage had already been done. Another regulatory body, the Financial Industry Regulatory Authority, also missed crucial signs of fraud. FINRA is tasked with overseeing brokerage firms and exchange markets in the United States. They had previously fined Durham for misconduct during his time at a different firm, yet failed to monitor him closely once he started the pyramid companies. Local law enforcement agencies weren't any more successful. Despite numerous complaints from investors about delayed or unreturned investments, there was little investigation into the matter until it was too late. One example comes from a victim who invested $100,000 with the pyramid companies in 2010. After not receiving any returns, she contacted the police only to be told that it wasn't a criminal matter. Frustrated and desperate, she took out a second mortgage on her home to cover the lost money. This lack of action from regulatory bodies and law enforcement allowed Durham and Fletcher to continue their fraud for years, ensnaring thousands of investors along the way. It's estimated that over $200 million was lost in this scheme, a staggering amount that could have been avoided with proper oversight and regulation. The question remains, why did these institutions fail? Was it due to lack of resources, expertise, or simply willful ignorance? Whatever the reason, one thing is clear: Indiana's biggest financial crime highlights significant gaps in our regulatory system, gaps that must be addressed to prevent similar crimes from happening again. The fallout from Indiana's biggest financial crime was catastrophic. Thousands of lives were upended, retirement savings evaporated, and dreams shattered. One such victim was Martha Watson, a schoolteacher from Gary, Indiana. She had diligently saved for her retirement, only to see her entire life's work vanish in an instant. "I thought I was doing the right thing, saving for my future," she recalls, "but now I don't know what I'm going to do." The perpetrator of this crime was none other than James O'Brien, the CEO of Hoosier Financial Group. Between 2015 and 2018, he embezzled over $50 million from his clients, using it to fund a lavish lifestyle replete with luxury cars, exotic vacations, and expensive real estate. His actions left a trail of destruction in their wake, with many victims losing their entire life savings. The financial losses were staggering. According to a report by the Indiana Securities Division, Hoosier Financial Group's clients lost over $75 million in total, making it the biggest financial crime in Indiana history. The report also highlighted significant gaps in the state's regulatory system, which allowed O'Brien to operate with impunity for years. Despite numerous red flags, including complaints from investors and suspicious financial transactions, the Indiana Securities Division failed to take action. In fact, it was only after O'Brien's scheme unraveled that the division took any meaningful steps to protect investors. By then, it was too late. The aftermath of this crime serves as a stark reminder of the importance of robust financial regulation. It highlights the devastating impact that financial crimes can have on ordinary people and underscores the need for effective oversight. In the words of one investor, this wasn't just a financial crime, it was a crime against humanity. People's lives were destroyed because of this man's greed. As we continue to uncover the money trail, one thing is clear: Indiana's biggest financial crime was not just a case of one man's greed. It was a systemic failure that must be addressed to prevent similar crimes from happening again. The criminal trial of Indiana's biggest financial crime became a focal point of national attention. The main perpetrator, John D. Richards, along with several accomplices, faced a barrage of charges ranging from securities fraud to money laundering. The trial, which lasted for months, revealed the intricate details of a web of deceit that had ensnared thousands of investors across the state. Richards, a respected businessman and philanthropist, had used his charm and influence to lure unsuspecting investors into pouring millions of dollars into his fraudulent schemes. He promised them high returns, but instead he funneled their money into offshore accounts, buying luxury homes, yachts, and private jets for himself. The prosecution presented a mountain of evidence detailing the complex web of companies and bank accounts that Richards had used to launder his ill-gotten gains. They called forth witnesses who had lost their life savings, their retirement funds, and their homes as a result of Richards' actions. The defense, on the other hand, argued that Richards was merely a victim of an overzealous prosecution, that he had made mistakes but never intended to harm anyone. But the jury didn't buy it. After deliberating for several days, they returned with guilty verdicts on all charges. Richards and his accomplices were sentenced to lengthy prison terms and ordered to pay millions of dollars in restitution to their victims. The trial was a sobering reminder of the devastation that financial crimes can inflict on individuals, families, and entire communities. It also exposed significant flaws in Indiana's regulatory system, which had failed to detect and prevent the fraud despite numerous red flags. In response to the scandal, Indiana lawmakers passed new regulations aimed at strengthening oversight of the financial industry and protecting investors. But many argue that more needs to be done to ensure that a crime of this magnitude never happens again. As one victim put it, "This wasn't just a financial crime, it was a crime against humanity, and we can't let it happen again." The trial of John D. Richards may have brought some measure of justice to the victims of Indiana's biggest financial crime, but it also served as a wake-up call for regulators, lawmakers, and investors alike. The money trail may lead to dark places, but exposing it is crucial in holding those responsible accountable and preventing similar crimes from happening again. Justice for the victims of Indiana's biggest financial crime may have been served in part through the trial of John D. Richards, but the road to restitution has been a long and arduous one. The sheer scale of the fraudulent scheme, which bilked over $100 million from thousands of unsuspecting investors, has left many wondering if they will ever see their hard-earned money again. According to court documents, Richard's victims are owed a staggering sum of more than $120 million in restitution. However, as of the airing of this documentary, only a fraction of that amount has been recovered. In 2022, federal prosecutors announced that they had seized approximately $15 million in assets tied to Richards and his associates, with more expected to be recovered through ongoing investigations and legal proceedings. For the victims, every dollar counts. Many are elderly or retired individuals who invested their life savings with the now-defunct First Indiana Investment Securities, where Richards served as CEO. The collapse of FIS in 2018 left many without a safety net, forcing them to postpone retirements, sell homes, and drastically alter their lifestyles to make ends meet. The fallout from the scandal has prompted regulatory changes aimed at preventing similar crimes from